Welcome to the Bookkeeping Puzzle. Lesson 6. Business Transactions. What we'll learn. How transactions are recorded using the double-entry bookkeeping system. Common types of business transactions. How transactions affect accounts. In the world of bookkeeping, a business transaction is any financial event that changes the financial position of a business. It must involve a measurable monetary value and directly impact the company's accounting records. Every time a business buys, sells, pays for something, or collects money, a transaction takes place. The dual impact of transactions. Bookkeeping uses a system called double-entry accounting. This means every single transaction affects at least two accounts. Think of it as a cause and effect relationship. You give something up, and you get something in return. For example, if you buy office supplies with cash, your office supplies account goes up, you got supplies, but your cash account goes down, you gave up money. The fundamental goal of a bookkeeper is to record both sides of this event accurately. Common types of business transactions. Most day-to-day business activities fall into a few standard categories. Understanding these common transactions is the foundation of solid bookkeeping. Owner's investment. When a business first starts, or when it needs to expand, the owner puts personal money into the business bank account. Impact: the business's cash increases, and the owner's equity, capital, increases. Purchasing assets with cash. Businesses often need equipment, vehicles, inventory, and supplies to operate. When these are bought using money straight from the bank account, it is a cash purchase. Impact: a specific asset account, like equipment or inventory, increases, while the cash account decreases. Purchasing on account, accounts payable. Often, businesses buy items or services from vendors and agree to pay for them later. This is called buying on credit or on account. Impact: the asset or expense increases, and a liability account called accounts payable increases, representing the debt owed. Selling services or goods for cash. When a customer buys a product or service and pays immediately, the business earns revenue. Impact: the business's cash increases, and the revenue account increases. Selling services or goods on account, accounts receivable. If a business delivers a service or product but allows the customer to pay at a later date, the transaction is done on account. Impact: an account called accounts receivable increases, representing money owed to the business, and the revenue account increases. Paying cash for expenses. Running a business involves regular costs like rent, utilities, advertising, and insurance. When these are paid immediately with money from the bank, they are recorded as cash expenses. Impact: the specific expense account increases, and the cash account decreases. Incurring expenses on account, accounts payable. Impact: the specific expense account increases, and the accounts payable account increases. Paying off a liability. When the business finally pays the bill for items previously bought on credit, it settles the debt. Impact: the accounts payable liability decreases, and the cash account decreases. Collecting cash from customers. When a customer who previously bought on credit finally pays their invoice, the business collects the cash. Impact: the cash account increases, and the accounts receivable account decreases. You should now know what transactions are and what the most common types of business transactions are. See you next lesson.